These topics were requested by a few people. I think I pulled this about 2 weeks ago, and we got a pretty good amount of feedback with regards to what we wanted to talk about. And so, because this is the first one in a while, I felt the best way to do it was to get an idea of what topics people wanted and kind of not gloss over, but just kind of go back to them, potentially review based on some of the content that we already have. Because some of these topics we already have, like I mentioned before, hours worth of content specifically focused on them. And we'll be referencing them, throughout. And I'll put a compilation of them at the end of this. But these are going to be a few topics that we've already spoken about. Probably some of you are familiar with. And I've kind of just threw like a little bit of my own, pizzazz or whatever you want to call it to, introduce a new concept or a new idea or perhaps something that we haven't spoken about too much in depth before. So let's get right into it. So I think I'm right here. Alex, you or Cam, you could probably correct me, but I think this is the 23rd class. So again, we'll be going right into it. The agenda for today. So based on topics that were requested, what we got was technical analysis, trade planning, and training your brain. So call it the three T's or however you want to put an acronym on it. But specifically what we'll be speaking about is support and resistance and how to find them. We'll be speaking about sticking to your strategy, and we'll also be speaking about psychological strategy. So again, these are all topics that we've spoken about at length before, but hopefully you could take a thing or two from some stuff that I've included that maybe we haven't spoken about previously. So support and resistance and how to find it. And again, I'll be panning out from other pieces of software, whether that be TradingView, Quant Data, and just let me know if you guys don't see my screen, but everything should still be good to go. Right now, we're still on the presentation, but the simple explanation, and again, I think this one was the longest amount of content. We have about 4 hours worth. It's like a 4-part series on technical analysis, but specifically what support and resistance is within that realm is a price at which there are presence of market participants. Now, what this means in layman's terms is that there's people there. So often what we'll find, I always see this, people talking about this in the chat, but we'll say the term no man's land. And usually when the market is in quote unquote no man's land, it's because there aren't any market participants, right? That's kind of the way to think about it. And so usually the way that I find at least these types of levels is based on 3 primary factors. And these are kind of what I felt is the best way to encompass it. So as you guys have seen, this is probably sound like a broken record saying this, but dark pool levels. So dark pool, and I don't want to go too deep into it because we can do an entire session on that. We could, bring Andrew from Quant Data, who knows a lot more about than me probably about it. But for the purposes of this topic, dark pool levels are essentially levels at which a large amount of notional value of equity is traded at. And this is considered an off-exchange transaction. Okay, so to put it simply, why they would make this off-exchange is because of the size of that transaction. So let's just take, for example, $100 million worth of SPY. Okay, and I want to sell my $100 million worth of SPY to Bob. So it can happen. I can definitely get my money for it. But the problem is that I can't go into the open market for that. What I'm going to have to be doing is I'm going to have to sell this in a dark pool exchange over to Bob in this case. And that's because the impact that I have, even from a $100 million transaction, which in the grand scheme of things is, not all too big, but let's think about 500. Let's think about a billion. Those transactions can have and cause, crazy stuff to happen in the markets, for lack of a better word. So, for the purpose of me not creating market volatility or giving away the position that I'm taking, because usually, and this is from more from a fund and asset management perspective, but you don't want your trades to have high impact. And that's because you don't want people to catch on to the trend, especially if you're the one setting it. So that being said, these levels are significant in the sense that there's a lot of market participants there. There's a lot of value being traded at those levels. And usually from my experience in using this, I'll usually deem them significant if there's a billion or more traded at that price level. And I'm going to pan over to quant data in just a few minutes to kind of show you guys how that breaks down. But usually what you'll see, and I'll show this, is a dark pool order book, and you'll see, a bunch of orders hit the tape at one specific price level. And you could just add that notional value up. And usually for me, at least, I find them to be significant at about a billion plus notional value traded. Some levels you'll see are something like 3, 4, 5. You could see $6 billion prints on certain levels. And typically that's usually what would deem it significant. Okay, so that's one thing that we've covered. Next is valuations, and I think this one we've covered a little bit less in depth. There's definitely more on our website than in our YouTube playlist on this. But again, this also kind of ties into how support and resistances are actually created, right? You have your demand zones and you have your supply zones. And these aren't created just because people necessarily are like, oh, yeah, Apple's trading at 125. I like it there. That's not necessarily all the time that happens. I mean, sure, you have your speculators out there that are throwing money at whatever the price may be. But the point is that when a stock falls to a certain price level, that does affect the way that those valuations are, essentially calculated. So let's take a PDE ratio as an example here. So what your PDE ratio is, and I haven't done this in a while, so let me make sure. Your PDE is basically the underlying price of your stock divided by its EPS, or earnings per share. And typically, let's just take, for example, let's make up a stock. So we have a stock and it's trading at $100 per share, and they reported a $2 EPS. So if we divide 100, and I have my handy dandy calculator. I'm not a quick maths guy, but if we take 100, we divide it by 2, that gives us 50. So a PDE of 50, which a lot of tech stocks were trading at or above during this bull market that we've had. So we have that calculation. Now, let's say the stock price continues to fall, but they continue to report, let's say, like another on their next filing, they also are reporting $2 EPS. So let's say the stock and I was trading at 90, and we divide this by 2, which is the previous EPS we used, and now is 45. So now it's being valued less, in the sense that if the stock falls but it's returning the same amount or greater EPS, then typically we'll see those support and resistances being created over time. And I'm going to pan over again to TradingView to show how that works out. But essentially, this is just a little bit of like a back end perspective as to how these are actually created, and eventually it creates things like psychological levels. So when we talk about psych levels, we talk about, let's take SPY, for instance, 350 or 400. Typically, those numbers that end in the 50, or those numbers that end in the 00. Tesla, for example, that's just the most recent thing I can think of. People were calling as like $100 for this major psychological level, which I think we actually came down to about like 102 or 105, something like that. So those are also kind of how that's created, because as we, whatever calculations that they end up making to value a stock, typically they kind of are at about, the 00s or the 50s. And that's essentially, they all fall into together. And so now I'll go over to TradingView and quant data to give you guys a better idea of kind of how all this ties in. So again, let me know if you don't see my screen. You should be able to, but just give me a heads up if you don't. So right now I am panning over to TradingView. So let me know if you don't see it. If no one says anything, I'm going to expect them all good. So, excuse me. So these are, and I've sent this a few times in the chat, so you guys might already be familiar with some of these, but these are all dark pool prints right here. So all these horizontal plots here are all dark pool levels that I have gotten from this dark pool window over here on quant data. And for those who aren't familiar, quant data is a options flow software They do all sorts of data aggregation and they spin it in all different types of ways, but generally speaking, they're an options flow platform. And they also get data such as dark pool exchange data. So this is where I'll be pulling it from right here. As you can see, I have it filtered to SPY. You can filter it to, whatever equity it may be, ETF, etc. Anything that's essentially traded for the most part. So what you'll see here is A, your notional value, and B, the underlying price at which it hit the tape. So these orders will they'll typically happen throughout the day. But as you can see here, they also happen in the post market. So you'll see orders hit the tape at around 4, 4:30, 5. But typically these will kind of come in throughout the day. So when you pull this up in the morning at 9:30, you'll probably see like nothing. Maybe you'll see a few pre-market orders. But as you see throughout the day, if there's volume in the market, it'll tend to stack up like it did here on the last Friday session yesterday. So that being said, I don't have the Excel sheet of when these were print, but I put these down probably the last thing that I put down that hit the tape was probably sometime last week. So we could probably do another thing now just for the sake of kind of showing an example. But this is how I personally have found these to be useful. And let's just zone in on day trading specifically. So let's look here. And again, we'll show a few examples. And if this is helpful, by the way, let me know. But I felt like showing kind of a real-time example might be a little better than just a chart on the presentation itself. But anyways, I'll be using 15-minute for confirmations, and I'll be using 5-minute for my entries. And I'll go into a little bit of detail as to why. Looking back on Friday's session, this is actually a good example here. So we opened down pretty sharply in the open. We came up here, and as we could see, 396.22. I think it was pretty significant. I think it came in at about 3 billion of notional value, all in all, around that level. And as you can see, typically what these zones will offer is market participants. So that's why we see things like consolidations, rejections, and booms or to the upside or to the downside, because eventually one of those market participants dictates what's going to be happening at that price level. So as we can see here, we came up, peaked above, sort of faced a rejection here, all to just come right back up here. And market participants in this case decided that the market was going to be going up from here. The market was no longer going to be rejected here, meaning sellers have kind of given up at this level. So as we can see in the 5-minute, it gets a little bit complicated here, because let's just say you're trading up to here and you're like, okay, I'm going to be waiting for a 5-minute close above this DP level, and I'm going to be, going for calls, because that means, participants have decided that we're going up. Well, the issue is you probably would have gotten chopped out. Maybe you would have gotten stopped out based on, this wick right here. And then you would have missed out on this entire move to the upside. And so that's why we can pan over to something like the 15-minute. So now let's say that you waited for a 15-minute confirmation here. Your trade's out right here on that next candle. So let's just say you got stopped out there. You're waiting. Then once again, you get another 15-minute confirmation candle above that dark pool level here. So maybe you decide to enter calls again for your second trade of the day, let's say. So you do that. And all the while here, what we can see is no closes thereafter under this dark pool level. We see wicks down. And if we pan over again to our 5-minute, we'll see even a 5-minute close. But again, that's why I think the entry points are a bit better on the 5 with your confirmations on the 15, because if you were to be using confirmations on the 5, and let's say your confirmation system is one 5-minute candle close under a dark pool level, well, you probably would have gotten stopped out. You would have kind of missed out on this entire move again. So if we were to say enter here, knowing that our dark pool level is right here, we would be saying, okay, let's look for another confirmation of a 15-minute candle under that dark pool level. and that's at least from past experience what I felt have been the most helpful in this case. No system is 100%, which is why we can see right here things like this tend to happen, but it does help mitigate risk. So again, we can see right here, we've wicked down on the 15, but we did not make any closes. And this is kind of the types of moves that you want to be using when it comes to dark pool. You'll tend to see consolidation, or you'll tend to see immediate bounces or rejections from them. It kind of depends on a few things. And so I think it's less about dwelling on what that depends on and kind of just seeing what the market gives you. If you're seeing consolidation around those levels, then perhaps wait. That's probably your best bet. But if you're seeing immediate bounces, immediate rejections, that might be a little bit more of an inclination to, place a market order, for example, and just go gun ho and having really tight stops and take profits with respect to these levels. So again, I think these are just a few that hit the tape the week before. So there definitely is a few things that I can add here. But as we can see, I think what was this session? This was Tuesday's session. We actually came right down to that dark pool level, and this one is actually a pretty old one right here. Yeah, we came right down here and proceeded to bounce. So it seems like 386.21. I have to look back, but it was probably something like 4 or 5 billion notional value traded at that level. And that's kind of why, just to give you an idea of how these levels can be significant. So I will probably be keeping everything here. I have another level up at 399.51. So we'll kind of have to see how we interact there. And I have another one at 401.81. So for the sake of maybe this week, plot those on your trading view and see how that turns out. So for the dark pool levels itself, you can go export here, which I actually think I have handy with me right here. Where's it at? Oh no. Oh, okay, there we go. So yeah, you can basically export this data here. And this is just an example of how that might look like. I filtered this for, oh no, this is just for the 13th. So you can do this for a week ahead. And I think this includes it. Let me just double check. Okay, yeah. So this is for the week from the 6th all the way to the 13th. So as we can see right here, let's see what significant levels we got. Seems like 394.10, 394.15. That was probably deemed significant. Let's see how much notional value was traded. 51, 100, 38, 39, 59, 39, 39, 39, 79, 39, 352 million at 396. So 396.96 is also pretty significant. So basically what I'll do here is I will very simply put, add up this notional value at whatever the level is printed here. So if this, let's say from 394 to 390, yeah, this is the last print right here. 294.76. There's actually a good amount of activity right here. So without just using my calculator, just based on eyeing this, there's clearly over $1 billion here between this level of 394.83 to 394.73 at the lower end. So that's something that we can potentially deem as significant and we can use for reference in our trading. Okay, so again, shoot any questions over in the chat. I don't think let me just double check. I'm gonna be using my phone. All right. Yeah. So again, shoot any questions. I'm more than happy to kind of just make this discussion based as well. So if there's anything during that confuses or you want me to expand on, feel free or feel free to interrupt. And we can go over that as well. Cool. So that's basically on dark pool. Now, when it comes to valuations as well, let's think about let's see, what's a good example here? I probably should have had this already scheduled, but I think let's think about Tesla. All right, so Tesla famously, I'm sure everybody's already heard has already been through the headline wins of Tesla and Their PDE being absolutely astronomical and being, the term overvalued was like a very popular term to be categorizing them as. But as we can see right here, Tesla found its low, its 52-week low, most recently at, what was it? 101.81. Yep, 101.81. So as we can see right here, Tesla was delivering at this level. And let's just use EPS as an example here. EPS of Tesla. Come on, give me some numbers here. Okay. So they reported a 1.05 EPS in their Q3 2022 report. So right now, let's just use that number as an example. 101 divided by 1.05, which was their EPS at the time. They're still valued right now. Their PDE based on this level sits at 96.19, which is a pretty frothy evaluation. But the idea, at least with US growth and tech stocks, is that they're implying some sort of growth prospects for, just to put it in simplest terms. They think the stock can do more than what it's at right now. So let's just take an example from when this was trading at $236. Let's call it that. Divided by, let's use the time. This was October 24th. Okay, let's use that same EPS figure, 1.05. So that valuation is like double essentially what it is currently. So we can understand how these valuations can create support and resistances based on what the market says it's priced at. For a while, it looked like the market wanted it at 300. That wasn't the case. It looked like the market wanted it at 200. That wasn't the case. And now the market wanted it at 100. And now we're going to kind of have to see if that's where value sits. Right now, we're seeing a lot of stocks, regardless of who it is. It can be an Apple, for example. We're seeing them come down to what's considered true value. And we can do, again, a whole another presentation on that. But I just wanted to provide a little bit of an idea as to how potentially, entities or organizations like funds, asset management firms, etc., use these valuations and essentially plot out what you see on the chart as support and resistances. All right, cool. So let's go next over to trade planning. This one is a little bit more of a brush stroke, but I did want to include one little, tip and trick equation that you could potentially find helpful. But these are kind of the 3 points that would encompass it. Plan your trade your plan, determine what options you want to trade and how you want to trade them, and have some sort of money management system and use it. So we'll go into detail on that. Let's see here. All right. So pick your market. So in this case, we'll be using the options or derivatives market. The derivatives market is the largest market by a long shot. This US stock market's about 80 trillion, and the derivatives market is a lot bigger than that. I don't have the figure off the top of my head, but definitely a absolutely massive market with lots of opportunity to be had. That being said, once you do find that, and in this case, we're choosing options, we have to pick our time frame. So obviously, what a lot of members in here will do will be engaging in day trading. A lot also will be akin to swinging, and potentially some of you are also, super into leaps, or what we would consider, options or hedging processes that might last a year or a year and a half. Some options chains go out to like almost 2 years. I think SPY does. So that's one thing that we need to keep in mind. And this is something that I think a lot of people would find helpful here. And this is something that I've definitely used before. And I think for the purposes of just understanding how risk might work, this is something that could help you. So Obviously, we want to understand how to find potential return. But I do think, just for the purposes of this presentation, the most important thing is risk, right? Because without skin in the game, you're done, right? No amount of paper trading money, I think, can necessarily replicate what it feels like to trade with your own money. So you need to understand how long you can be in the game if shit hits the fan, because ultimately you need to be prepared for the worst and hope for the best. It sounds corny, it sounds cliche, but in the world of trading and investing, you need to be prepared more so for the downside than in my opinion, than to be able to capture upside, because you can capture all the upside you want, but if you don't know how to handle downside risk, you can wipe yourself out in a day. We've seen it happen, and it's definitely not a pretty sight. So one thing I wanted to zone in specifically is probability of ruin. So let me just go to my notes really quickly so I don't mess anything up here. Okay, so probability of ruin. Probability of ruin, in the simplest of terms, tells you how much money you can lose. And if you want to stay in the game, like I said, that's the most important aspect, in my opinion. So it doesn't matter if you're hedging or if you're trading naked options. You could find this probably pretty helpful just to get a better understanding of how you're taking on risk. So I'm going to actually pan over to this equation thing just to be able to show you guys this. So that equation that we looked at before is, we'll call this R, is equal to 1 minus A over 1 plus A, and then to the power of U. So R is your probability of ruin. And basically, the lower the number, the less risk in your trading strategy. And I'll go into an example in just a few minutes here. A is your advantage on each trade. Okay, so what that means is it's the difference between the percentage of losing trades and the percentage of winning trades. So if you win 55% of your trades and you lose 45% of the time, you just subtract that. So 55 minus 45. So your A, or your advantage, is 10, or in this case, 0.10. So let's just say that you have and then U is the number of trades that you would take. And that could be 1, 2, 3, 4, 5, 15, 20, whatever you fancy. That kind of goes into picking your time frame, as well as picking your market, right? Because that also depends on a few factors. So let's just say that you have an advantage, or an A of 0.10. So let's just say you win 55 and you lose 45% of the time. So let's go right here. All right, so let's see. Okay, so let's do exactly what that equation was showing. So 1 minus 0.10, and then we do 1 plus 0.10. And we'll take that. We'll do it to the power of the amount of trades that we take. Let's just use a 5 as an example here. See if it'll work for me. All right, cool. And it doesn't do the final calculation, but I do have my calculator here. So what it does come out to is 0.59049 divided by 1.61051. And what we get is 0.36647382, and so on and so forth. So let's just multiply that by 100, and we'll round it to 36.7. Okay. So what does this tell us? Basically, if all your trades go to zero, you have a 36.7% change of losing all your money. So to reduce risk in this case, there's two things that we can do. We can either improve our advantage, or we can make more trades. And we're going to see how that kind of affects it as well. So, because options, they can expire worthless. If you let your options run to minus 50%, then they're virtually going to be worthless very soon thereafter. That's just the case most of the time. A lot of people also leave runners that could go worthless, and so this is also an important part to understand. I think that with this, people might again, it's not like something that you would use for every single trade that you do. You very well could. If you're very meticulous with this, then it could potentially help you. But this just gives you a better idea of how risk works. So let's just take this equation and let's say we improved our advantage to let's say we're winning 65% of our trades and we're losing 35% of our trades. So what we're going to do is we're going to take 65. Oh, 65, and we're going to subtract it by 35. Actually, no, that's a that's a pretty drastic difference. Let's do 60-40. So in this case, our A, so 60 minus 40 is 0.2. So we'll keep that, and we'll keep the same amount of trades for the purposes of the example. So let's find that calculation, and that gives us 0.37, or sorry, 0.32768 divided by 2.48832. And what does that give us? That gives us 0.13168724, and so on and so forth. So let's multiply that by 100, and let's round for the sake of simplicity here. That gives us 13.2. So again, what does that tell us? That means that if all 5 of our trades goes to 0, that we have a, whatever it was, 13.7% chance of losing all of our money. So again, this is something you can mess around with this equation. You can, change the numbers however you want. But this just gives us an idea. So let's just go in this case, let's go back to our original of a 10% A. But let's increase our trades here to 9 trades. So what does this give us? This gives us 0.3874289 divided by 2.357947691. All right, now what does that give us? That gives us 16.4. I'm just going to round here. But as you can see, this is just an example here. We didn't have to improve our A or our advantage, right? We could have taken more trades in this case. So instead of taking 5 trades, we could have taken 9 trades and then lowered that probability of ruin by 50%, right? Because let's just take it back to our original example here. On a 10% A or advantage with 5 trades, we had about a 36.7% chance of ruin, probability of ruin. Now, all we had to do to delever that by just about 50% is take more trades, and vice versa. With the same amount of trades, we would have needed to improve our winning percentage by about 5%. So again, this is just to give you an idea of things that you can potentially do to lower risk. And as I stated before, without that, you can get all the upside in the world, and you can lose it all in a day if you don't know how risk works. So again, hopefully that didn't confuse too many people, but I do think this is just a fun little tidbit that you can mess around with and, provide you a better idea of how risk kind of works in this environment. All right, next. Training your brain. So again, this one we do have about like 3 hours worth of content that we've covered previously. So again, I'll reference all the more in-depth extra content that we have on training your brain and support and resistance. The second one was a little bit more, not what we have already, but this is basically something that we've covered before, and I'm going to kind of review and again add a little bit of some personal anecdote perhaps to enhance your understanding of this. So 3 things that I kind of want to cover here is controlling your emotions, tying back to our second topic, planning your trading, and knowing when to walk away. So trading your emotions. So I think, and this is kind of a combination of what I've seen and from a few books that I've read, but these are kind of the emotions of trading. Please let me know if you've experienced any others, or you think any other type of emotions would fall into this, but I think this encompasses it pretty well. So you have doubt, fear, greed, overconfidence, anxiety, boredom, and depression. Now, I think we all know what all this means, but I just want to provide a little bit of context as to what this means in the realm of trading and the realm of investing. So doubt creeps in whenever the trading isn't going exactly the way that you want it to. Like, oh, maybe I should get out now. Like, even if it's working out, like, do I get out now, or do I increase this position, or should I have like doubled up on this? Should I have closed it out like a few ticks ago? These are all instances of doubt. And typically this will happen when you don't stick to your plan. So the more you trust your plan, the less doubt you'll have when trading. Easier said than done, but that's just something to think about. Next, we have fear. So, as we know, options is a zero sum game. There's a winner and there is a loser at the end of every transaction. So, it can be kind of scary to be on the losing side, I guess, is the best way to put it. Like a little fear is okay, because I think it's only natural, but you have to make sure that you're not behaving recklessly as a result. So, placing trades without the market telling you what it needs to tell you, or having too much fear, will keep you away from taking the appropriate amount of risk that you need to take. And then you'll say, oh, I could have made so much more. And why that would be the case is because you were fearful of what potentially could happen. Third one, which I think everybody here and myself is very familiar with, is greed. So as traders or as speculators, we're here to make money, right? That's what we're here to do. So we would think that like maybe greed might be a good thing, but I would like to think that's not really the case. Greed is greed is basically it's a desire for what was like the saying that I'm looking for? Greed is the desire for more money for its own sake, just to have more money. Like a trader in the realm of greed, they'll take too much risk, they'll cut corners, they'll wait too long to close out a trade, questioning all of your decisions. You'll never be satisfied with your trading. And so, like in the push to get more and more and more, you'll get screwed. The saying that I think resonates well with this is pigs get fat, hogs get slaughtered. People speculate to make money, but the drive to make money can definitely cloud common sense. So just keep that in mind. Next, overconfidence. So we do know that confidence is great. I don't think confidence is bad. Overconfidence, however, is lethal. And why I say that is because the moment that you think you have it all figured out, and I've fallen a victim to this before, but over time you get humbled by the market. Once you think you have it all figured out, something will happen that'll trip you up. I have no idea what it could be. I just know something will happen and it'll trip you up for sure. So many traders think they can't do it wrong, or that they figured it all out, and so they take too much risk. You start to get sloppy, you stop planning trades, you stop tracking trades, you break your risk limits, you brag about what you're doing. That's like the one indication. Like as soon as I see somebody bragging about making huge sums of money or doing something really, really well, I know something is about to trip them up. I can just feel it. So that's something to keep in mind. And whenever this happens, like the inevitable will happen. It's definitely not something you want to fall victim to. And I mentioned this before to a few people, but I think the worst thing that can happen to a new trader is for them to make money, because then they think it's easy. And so perhaps like some people need to get humbled by the market in order to learn. Some maybe don't, but I do think that it's just basic human psychology for us to get humbled by these forces before we actually learn. And then lastly, I do want to I don't want to go too quickly over these, but anxiety. So I think anxiety comes from position sizing a lot of the time. So this again ties back into risk. If you're feeling your heart literally beat during a trade, that's a pretty good indication that you're not positioning yourself correctly and potentially you're risking more than you're willing to lose. So that's just kind of a little bit of a gloss over that. Boredom, which I think this might tie back into overconfidence as well. If you're just trading for the sake of trading, you're like staring at a screen for 3 hours and you haven't found anything, and then during the fourth or fifth hour, you're like, this looks good. It doesn't actually like fit my system to a T, but yeah, I haven't done anything all day, so let's take a trade. That's a pretty wrong way to think about it. Like the modern trader working off computer screens is likely to feel boredom more than often, which is why this practice is not as sexy as it's put out to be. And so the temptations for alleviating boredom are there's many temptations, definitely. I think there was like let's just take like the memes or the BBBYs or whatever. Like if the market's not doing anything and you see these memes run, your boredom can get to you because you're saying, "Oh, SPY hasn't done shit all day. Let me trade this thing that's moving, because I'm bored." That's just an example. And lastly is depression. I think that, and I'm not talking about the clinical. I mean, I guess in the sense that you can develop a clinical illness the same way that you can get it from anything. If you hurt yourself on if you break your arm in a construction job, that's like a physical injury. The same thing can happen in trading, except it's mental. And it interferes with many aspects of life, right? Like if everything seems hopeless to you, you're less likely to take the appropriate risks and to follow through with your trading plan. You'll just sit and be sad and do only the work you need to do to trade. I think some of it does clear up with time. And, if trading really is bringing you down, you should walk away because no one is saying you have to do this. This is something that you put on yourself to do. And if you can do it, then you continue to pursue it. But I think it's just something to think about because it's something that, shouldn't necessarily be overshadowed when it comes to talking about emotions in the trading realm. So again, I do know I was going off for a little bit longer than I thought I would, but overall, this is just like a gloss over. This is some topics that actually probably I would say 80% of this we have like extensive content in our YouTube for this, which I'll be linking down below. But this is something that we wanted to bring back. We wanted to kind of reinvigorate it, so we'll have something going on 7 days a week. I think that's incredibly important. Adds value to yourself as a member, also adds value to the product, and to the service. And so, I thank everybody for their time. All the reference videos, again, I will put here, and they also can be found on our YouTube channel, OBR Investing. No spaces, no caps, no nothing. That's across all socials. And access to the software mentioned, TradingView, I think everybody's familiar with. But if you're interested in quant data, we've been partnered with them for the better half of a year now. We've known Andrew, the founder, for quite some time. Great guy, great product, and would highly suggest taking a look if you're interested in using it specifically, like for dark pool, as I mentioned previously. That can be found in hashtag OBR links in the server. So without further ado, I'll take any comments, questions, concerns, etc. I haven't looked at the chat, so just give me 1 second to pan over there. But yeah, feel free to shoot them out. I'm just catching up here. Let's see. Okay. Caleb, you're in here. You said fundamental DCFs also liking the 110 area as another idea as well. Did you want to expand on that for a minute or two before we move on to the next question?
Yeah, 100%. I definitely can. So, Ben, this is like earlier when you were talking about like, fundamental analysis with PD and things like that. So, one of the big things that kind of goes into, not necessarily the dark pool levels in and of itself, but a lot of the equity buying that tends to happen around those levels, tends to come from large, hedge funds like BlackRock and even JP Morgan, Goldman Sachs, liking certain stocks around those same kind of fundamental levels.